I'm really happy to get into business of today. So what I will do is that I will start by breaking down the strategy. Then after that, I'll give you guys chance to answer. I mean, ask the questions from there. So those of you who are new here, we're dealing with the footprint strategy, which is the strategy that is applicable on all the time frame. There's no specific time frame where you need to specifically like apply the strategy. You can apply it on volatility index, basically all indices and currency pairs, stocks and everything. So what I will do now, I will just illustrate how normally the strategy is implemented. What I'm going to draw is the normal behavior of what we're looking for or the pattern that we look for. So now what I just drew here, I'm going to draw lines on top, and on those lines, I'm going to give them names. The first line is the footprint line. Footprint line. The second line that I'm going to be drawing, it is called the first layer line, which is the most important line. Should be able to draw. First layer line. And first layer line. So the way we go about with the strategy is that we normally wait for the market to break the first layer line. And after the breaking, give me a second. All right. So we simply wait for the market to come and break our first layer line. After it breaks, we know that for a fact that, okay, the market is about to go into the opposite direction. But knowing that the market doesn't actually move in a straight line, we have to wait for a retracement so that we can use our own technique that we use in order to make entries, which is a divergence technique, right? And after you wait for the pullback, now you will start observing 2 points, this point and that point. And you will compare those 2 points in relative to the stochastic indicator, which is an indicator that we use in order to make an entry, even though to make re-entries. No? So from there, an example of how that happens is that I'm going to show you the buy footprint. I mean, a buy divergence, so that you guys can see what I'm talking about. Perfect, there we go. So I'm gonna show 2 points. Actually, before this, let me show a full setup so that it is very much easier for you guys to understand, and a very much clear setup for buy. Okay, I would say in overall. Okay, there we go. It's even a setup. I think from here, this is the same structure that I've shown. This is the same structure that I've shown here. So you're gonna spot divergence. So um, check this out. What happened here? Immediately after the breakout, the market retested now the first divergence using this time frame. I compare the points, and I'm using the vertical line to show exactly where the market was and where the stochastic was. So the market was here when the stochastic was there. The market was there when the stochastic was there. So what you're seeing here, it is the total. What you're seeing here, it is the total opposite of what is actually happening. Now, the final confirmation will be, this helps because like it is a structure that is already happening. And if you would have taken it, you'll be in profit already. So you guys can see these two lines. So immediately after you spot your divergence, you will want a divergence where the market touches the oversold when we are buying and the overbought when we're selling. So now we want the market touch the oversold in a form of a divergence. Now the final step, it is waiting for these two lines to cross each other. You wait for the purple line to cross the orange line. Immediately after they cross, that's when you start entering a buy. So you see immediately after they cross from here, the market started moving into our direction. So this technique, it is the one that you're using. It is the one that you're using here. So after that, you're gonna get on a buy, you place a buyer, get on a buy. As for that, you have to wait for the market to formulate a new structure like that. But as it keeps on doing that, making retest, because retest, that will help the structure to be formulated. You use divergence in order to pile up trades here. And as you use divergence, when you are able to find a structure that is very much clear, where you can be able to draw your footprint, and after you draw your footprint, you can be able to draw your first layer. Then from there, you know that I just told you guys, like when the market broke here, we wait for it to retest. And like when it breaks here, we know that it is about to go into the opposite direction immediately after it broke there. Now, if this market decides to come and break the first layer line, what does that mean? It means that we must close all the buy trades and start focusing on a sell trade. So in that case, that's our take profit. And our stop loss, when the first trade that you entered here, we put our stop loss under the first point or the last point of that trend. So meaning you're going to enter here, entry, and here you're going to put your stop loss here. So with that being said, the distance from here to there, it must always, obviously it will be calculated, it will be in pips. For example, if it is 50 pips, our risk management ratio goes this way. You must risk the money you're willing to lose with this particular trade. We don't, if you have $10,000, you don't put the entire $10,000 in one trade. It is very stupid to do that. What you do is that you can risk $1,000 or even $500 per trade. When you use $500, you calculate the lot size that you know when there's $500 in that account and it's 50 pips. You calculate the lot size that will be equivalent to like 50 pips, meaning if the market goes against you 50 pips, you will lose that 500. So that means the lot size you would have used here, it is equivalent to amount of pips. No, not equivalent to amount of pips. Like the pip value, it is equivalent to your entire capital from there. So as the market continues to go up and you add more trades, that will help you to also leverage so that when you make money, because with the same distance, you find that from here, from here, from here, you can see that that's another 500 profit, that's 1,000 profit, that's 1,005 profit. Now it's 500, it's 1,500 on this lot size or on this trade, this first trade you took only, excluding the re-entries. Now, when you come to the re-entries and you use a bigger lot size like 75% or more, then you will start calculating more because you find that with this from this distance to that distance, you find out this trade only gives you, because this lot size, it will be based on also the profit that you've also made. So you'll find out this trade only can give you 1.5, depending obviously on the lot size you're using. And when it gets to this point, it gives you another 1.5. So that way you already have 3,000, actually 4,500 from just 500 deposit. That's how we leverage, simple as that. So this strategy is very effective in terms of you can hit the market going up, going down, and each and every movement you are able to monitor it. Okay. What I mean about that is as you wait for the market to break and make a retest, you get onto the opposite direction. As it continues to make some retest, then you add more trades. And from there, you will draw your same lines again, your footprint. After that, you draw your first layer. Immediately after the first layer gets broken, you know you have to get on a trade. Not get on a trade immediately, wait for the retest, of course, and wait for the retest and make a pullback, be able to enter a buy, take it up like that. So this is how the market moves. And to fully show that, I can say before this buy that you're seeing right now, there was a sell that was supported by what? The footprint. So I'm going to use this one as a footprint and use that one as a first layer, and then the market went down from there. And as the market kept on going up, some could have used this one as a footprint And after that, could have used that one as a first layer. The market still piled up, and what is beneficial about this thing is that with one movement like this until like going up like that, you can make money that can last you for years and years and years and years, if not decades. So if you teach yourself how to spot that opportunity, they're everywhere. They're literally everywhere. You just need to be good with spotting them. Because I can spot them like every day like this. And I want you guys to have this in mind so that you know the possibilities you have in this thing. This trade was very clear without any, and it didn't even go against you, even a single bit. From here to there, even one bit, it didn't go against you. After the crossing over, you start piling up your trades. So I want you to imagine how much money, if you can just white talk for one trade and just pay attention. I mean, just from that distance to there while making re-entries on the way. It is a life-changing money, and it only takes one of that trade. So, and when you are exposed to as many footprints like this, it's quite heaven, because you know that with one attempt, everything can shift. And from here, we've been spotting the footprint. From the top here, and pay attention that every movement, whether the market is going up, going down, there is a footprint. Even if I can go to 1 minute of 1 minute, I'll find a footprint, okay? So, it just happened. I'm talking about things that happen now, like literally now. So if you are on this trade, you should be in profit right now. Simple. If you're operating on 1 minute, you should be in profit right now. Simple. I mean, you guys can see this. Not more I can say about it. This is self-explanatory. Everything is simple. 1 minute, you can kill 1 minute. People you are dating, you will think you are bewitched or something. Because this thing is very much clear. You don't need any more things. See, in Forex, if you are convincing yourself that something is working, that means that thing it is not working. If something is working, you should be able to see it with your own eyes, that this thing it is practically working. You are seeing it with your own eyes. Now, if you have to like convince yourself, because there's some people who get to a point where they convince themselves that a system is working, a robot is working. If something is really working, you will see it with yourself practically that this thing it is working, and it will be much self-explanatory because of the chart is the same. So there's no secret candles, there's no nothing. The movement is the same. And if you have a consistent way of making money, it must also mesh to that same sequence that is actually happening on daily basis and on all the time frames and on all the charts. So that way it becomes very much better. Is there anyone who doesn't understand what I'm talking about here?
I have a question, please.
All right, no problem. Shoot.
Okay, we're looking at the vertex, the tip now, the trend line, where they hit the trend line. Now, comparing it with the stoke, is it also okay to say the divergence when that of the stoke is on a straight line and that of the chart is a slant line? Can we still call it a divergence?
Let me try to make sure I understand what you're talking about. Because divergence, what we do, we do the total opposite of what is actually happening between the stochastic and the main chart. So you find that for a sell, this is what we're looking at. For a buy, this is what we're looking at. These are the only divergence that we do. And we don't do these kinds of divergence because they are very dangerous. Let me show you. Okay, these ones, where you compare this point and this one, these ones. Why I'm saying they're dangerous is because of they are opposing a trend and you haven't fully found out if there's an edge where a trend is about to go into the opposite direction. What is happening that they can show you hints of retracements, and if you can enter in like with those retracements, you will think that they are going for a long haul, but it will be very disturbing. And one main example I can show you is that I want to show you how many of those things happen, and you will think that the market is going into the opposite direction. Let me show you. Okay, I can use this one. Between this one and that one, this one and that one. I'll enter sell thinking that the market is going up. It continue going up, going down and continue going up. Another one, the market will continue going up. Another one, the market will continue going up. So this is the danger. So this is definitely the danger. And if in this case, what you do is that, okay, you say, okay, I'm seeing a divergence here. Okay, that's very dangerous. What you're doing is very, very dangerous. So the strategy was in terms of, I know any that can convert can, and it wants to go into the opposite or a barrier, so that I see if the momentum is not control when the market will have to break and go into the opposite direction. Now that will take the inside